Ladies and gentlemen, boys and girls, my name is Subrata Sarker. I'm a mechanical engineer working in manufacturing industry more than 22 years. Today I'll be sharing some basic information and understanding about the financial or capital market of India. Financial market of India is basically under the Ministry of Finance and under which there are two controlling body. One is the SEBI, Security Exchange Board of India, and another is the RBI, Reserve Bank of India, and the stock exchange etc. under SEBI, and this under stock exchange there are broker, dealer, and agents. So this is basically the structures. And in the financial market there are three broad subcategory. One is the security market, one is the forex market, and another is the derivative market. And in security market there are two basic types actually, categories as you can say. One is the capital market and another is the money market. And in capital market there are two major parts. One is the primary market and another is the secondary market. And in primary market it has got two major subdivision. One is the equity market, one is the debt market. So we'll be discussing today about equity market and debt market. Equity market means basically which you conventionally understand as a share market, that is equity market, and debt market is basically which you basically understand as an investment doing in the banks like fixed deposit etc. and it's simpler to understand. And we all know that how the money is increase actually like when we are giving money to the banks, and banks after sometimes give some return in the money. So bank obviously doesn't keep the money inside the bank actually, because so money is increased the way actually some investor collect the money like banks or other private institution. They invest those money into the industry. Some industry is doing manufacturing, value addition etc. doing their business, and then they share those part of the profit to the banks or financial institution, and subsequently they share with us in a proportional way actually. So this is basically the cycle. Then if we see the turnover wise, India's total financial markets, like which types of the things are contributing more. So number one is the money market, number two is the equity derivatives, number three is the forex market, number five is the equity market or the share market, the total contribution, and number five is the government security market, and number six is the corporate debts. And now there are the basic class of the assets actually normally. So in different class of assets you will get different types of the return. For example, from equity, if you invest your money to the equity market, you will get on an average return from 15 to 25% as per the statistics of last 15 years what has happened. And if you invest in the gold market, your return will be around 6 to 8%. And if you invest in the the property, that is the in building, construction etc., real estate sector, your return will be about 7 to 12%. And if you put your money into the banks in fixed deposit, term deposit etc., you will be getting only 6 to 5%. And the average inflation rate of India is around 6% more, 6 to 7%. So what is the use of money keep putting into the banks? Bank is giving less interest than the inflation rate of India. So it is basically, if you are putting your money into banks, you are not gaining money, rather you are losing money. So a major portion of your investment should be invested in the equity market to get the optimum result. But obviously there is a risk factor actually. When you are putting your money into the debt market, you have a guarantee to get this much of return, but that return is not very insignificant actually. But in equity market you can get a major return, but you may not get also. Risk is always there in the the security market. So basically by any fixed deposit or any means you can get maximum 7% output interest from the banks, and by after post tax return rate is 6%. Finally resulting you will be getting in only in 6%. Now who regulates the Indian money market actually? Indian money market is basically regulated by the SEBI, as I said earlier, and the secondary market, that is the share market, it's regulated by two security, like one is the BSE, one is the NSE. The BSE means Bombay Stock Exchange, NSE is National Stock Exchange. Other than Bombay Stock Exchange and National Stock Exchange, there are 21 more regional stock exchange in India. It is mainly the capital of all the states, in Kolkata Stock Exchange, like Ahmedabad Stock Exchange, like that actually. And if we like to understand how big is the Bombay Stock Exchange, who regulates this, the secondary market. The market caps of the Bombay Stock Exchanges last financial is 1.54 trillion US dollar, and number of the listed companies around 5,700 companies, and their indexes are like BSE index, and BSE 500, etc. And for the National Stock Exchange, the NSE is the total market cap is around 1.41 trillion US dollar in last closing financial year. And the number of the listing companies NSE is very less actually. In companies under the BSE, it is about 1600, close to 1700 companies are listed, and their indexes are Nifty 50, Nifty 500, etc. And if we talk about the world's top 10 stock exchanges, one is the European Stock Exchange, one is the London Stock Exchange, Dubai Stock Exchange, etc. And in this way, Bombay Stock Exchange got up as ranked in the 10th in this whole world actually. So it is very matter of proud actually. Bombay Stock Exchange BSE is the 10th position in the whole world. And if we talk about the market caps of the world top 10 countries, so obviously it will be number 1 in US, then China, then Japan. So in this way, India's number comes in the 9th position, and Switzerland comes in 10th position. And in the whole world, the total market caps in the whole world is 66 trillion US dollar in closing of last financial year. And if India, when people are going to invest their money into debt market, that is in the banks, etc. So we need to have a basic understanding which bank is the biggest, which one is the largest, which one is the smaller. So we need to have a basic understanding who is the best bank or who is the bigger bank actually. So if you say the market share wise, if you say the State Bank of India has got the largest market, in the second position is HDFC, in third position is LIC, fourth position is ICICI Bank, and in fifth position is Axis Bank actually. So we should have a basic understanding of all these this data, and today all data are available in internet, you can get very easily. But when we are talking about the investing other than the banks, etc., like in the share market or equity market, so obviously there will be some risk actually. But the risk are also, there are two types of the risk. One is a systematic risk, one is unsystematic risk. Systematic risk means like there is a change in the interest, the market fluctuations, there is an inflation altogether, which is a known factor in the economics. So it is a systematic risk, it is there, and the financial expert people, they can control it. But sometimes the unsystematic risk also come, which is not very favorable for the investor. But always there is where there is a risk, you will get more return. Where there is a less risk, you will get less return. So it's a very basic understanding. So if you put your money into bank, you have no risk, but you will get very less return. If you put your money into the share market, it is risky, but you will get much more return, provided you have a lot of knowledge on it, and you will daily actually monitor what is happening in the market. That's very important. And there are a lot of people actually, professional people who are sitting in front of the computer the whole day, those who are into the financial market or the share market handling. So you'll get there are a lot of professional organization from where you can get the suggestion through email or SMS that which share needs to be sell or buy or something. So if you get into the market individually as a person, and then you can learn actually, and you can handle these things actually, your money can get the best possible return actually. And today, all apps are there in the mobile phone, like money control, etc. So if you go through this, for a few months, you'll be able to understand actually. There's no rocket science actually in this to understand the basic financial market in India actually. And also there is a lot of development. Earlier, there are for suggestion anything you need to meet with the expert people. They will give suggestion and you will do accordingly. So today it's not needed actually. And even in future actually, say after 20 years, you will get all auto suggestion. So there is a robotic system or computer-based system which is already there in place in European and American countries. They don't consult with the people actually, because they have a lot of data bank, and this computerized data, the robotic gives results and suggestions, and people are doing accordingly actually. And I'll share one of the proportionate data for the Indian individuals. What should be their investment proportion that has been suggested by the robotic system. That is, it's suggested that if in India a person who is say 40+ plus years and working in as a employment somewhere in jobs something, not in business, because then it will be very difficult to specify. So that is suggested that your 80% money should be invested in the stock market and your 18% money should be invested in the debt market, that is in the bank, and you will keep only 2% cash in your hand actually. So this is the robo suggested investment plan for the Indian actually. So if you find this presentation is informative and neutronistic, you can share this presentation with your friends. And if you have not yet subscribed my channel, you can subscribe my channel by clicking on the bell icon so that you can get the notification for my upcoming presentation. Thank you very much for your attention and time.